We all want financial stability, right? Financial freedom. But what does that actually mean? Is the big challenge really about where we should be putting our money? Or is it about how we should be thinking about our money in the first place? Let's dive into that.
Okay, before we jump in, just a quick but really important heads up. This whole explainer is for educational purposes. Things like tax rules and interest rates are always changing. So please make sure you talk to a qualified professional before making any big decisions. So let's get right back to that central question. Most of us, especially when we're just starting out, we're hunting for that perfect investment, that one best place to put our money. But what if that's the wrong question? What if building a truly secure financial future starts not with a product, but with a whole new mindset? And this quote from Morgan Housel, man, it just hits the nail on the head. He says, our own personal experiences with money, which are just a tiny, tiny fraction of what's happened in the world, make up maybe 80% of how we think money works. Just think about that for a second. The way you grew up, what your parents taught you, that little slice of life can become a huge blind spot out in the real world. This brings us right to the investor's biggest dilemma, the stock market. Yeah, it promises amazing returns, the chance to beat inflation, but it also comes with this heart-pounding risk that can be absolutely paralyzing. It really is a two-edged sword.
And this chart, well, it shows you that risk in broad daylight. Look at the Indian stock market here. After climbing for years, it just plummeted by 34% when the pandemic hit in 2020. I mean, can you imagine if you needed that money right then? Years of hard-earned gains could have just, poof, vanished.
So, this is probably the most crucial takeaway. The stock market is a marathon, not a sprint. If you need your money for a big, specific goal in the next 5 to 7 years, a down payment, college fees, that volatility makes it totally the wrong tool for that job.
But on the flip side of all that scary volatility, you have this beautiful, steady curve. This is the magic of compounding. It starts out so slow, you can barely see it happening. But over time, it just picks up speed, turning your small, consistent savings into some serious wealth. The secret ingredient here isn't just what you invest, but how much time you give it to grow.
So how in the world do we balance this need for safety with our need for growth? Well, let's think about it like building a house. You wouldn't start by putting up the roof, right? You'd lay a solid foundation first. The exact same logic applies to your finances.
Your financial house absolutely needs an unshakable foundation, one made of secure, stable investments. This foundation is your shock absorber. It's what makes sure that when those inevitable stock market storms roll in, your whole financial world doesn't come tumbling down.
Okay, so let's get practical. How do we actually build this thing? What are the real-world bricks we can use to lay this super strong foundation for our financial home?
Now, for salaried employees, the first cornerstone is almost always the Provident Fund, or PF. It's an automatic saving that just chugs along in the background. And honestly, the best advice is usually the simplest. Just let it be. Unless you're in an absolute emergency, let it sit there, let it compound, and let it quietly build your wealth. For everyone else, or even as an add-on to your PFF, there's the Public Provident Fund. And I love this analogy. PPF is not a flashy race car promising a quick thrill. It's an armored vehicle. Its only job is to get your money to its destination safe and sound. It's got 3 killer features: guaranteed returns, a fantastic EEE tax status, which means what you put in, the interest you earn, and what you take out are all tax-free, and a 15-year lock-in that kind of forces you to be disciplined.
Now, let's say you have a really specific goal, like saving for a daughter's future. You might run into the Sukanya Samriddhi Yojana, or SSY. It tends to offer a slightly higher interest rate. But the choice really boils down to this question. Is that little bit of extra interest worth giving up some of the flexibility you get with the PPF? It's a personal call, depends entirely on your goals.
So once that rock-solid foundation is in place, it's time to build the walls. These are the hybrid structures, the things that connect our secure base to that high-growth roof we're aiming for.
And this is where the National Pension System, or NPS, comes into play. It's a really unique tool built for one thing: long-term retirement planning. It automatically invests your money in a mix of assets, some in higher growth stocks, some in stable corporate bonds, and some in ultra-safe government securities. And what's so brilliant about NPS is how it manages risk over your lifetime. You can go with active choice and decide the mix yourself, or you can pick auto choice and it will automatically gradually shift your money from stocks into safer bonds as you get older. It's a super smart set it and forget it kind of strategy. So what happens when you turn 60? Well, the whole system is designed for security. You can pull out 60% of your total savings tax-free. The other 40% has to be used to buy something called an annuity. All that is a contract that pays you a regular, fixed pension for the rest of your life. It's basically a guaranteed paycheck for your retirement.
Okay, we've got the foundation. We've built the walls. Now let's step back and take a look at the finished product. This is what a truly resilient financial portfolio looks like. And there it is, your financial home, a solid foundation built with things like PPF and PF, sturdy hybrid walls constructed with NPS. And then, way up top, you have the roof, your growth assets, your stocks, your mutual funds, reaching for the sky. Every single part has its own vital job to do.
And this, right here, this is the ultimate prize. This structure gives you a buffer. It gives you options. When the stock market has a meltdown and drops 30%, you don't have to panic sell your growth assets at the absolute worst time. You can lean on your foundation, and you can calmly wait for the market to recover. That is what real financial peace of mind feels like.
This quote just sums up the whole philosophy we've been talking about, doesn't it? In investing, trying to get rich quick is very often the fastest way to get poor. A slow, steady, disciplined approach, that's what actually gets you to your financial goals. So, I'll leave you with one final thought to reflect on. Go back to that Morgan Housel quote from the beginning. What are the stories, the experiences from your own life that are quietly pulling the strings on your financial choices right now? Because understanding your own biases, that's the real first step to building a secure future. Thanks so much for joining this explainer. Remember to use this framework as a starting point, and then go work with a financial advisor to build a plan that's perfect for you.